Hey there! If you're a freelancer, a sole proprietor, or you run your own small business, you know all about Form 1099. But what if I told you that a super common error on that form could be making you overpay on your taxes year after year? Let's dive into this costly little mistake.
I want you to really think about this for a second. Could you be paying tax on money that was never actually yours to begin with? It sounds crazy, right? Why on earth would you pay tax on money you just handled for a client but never really earned? Well, it happens way more often than you'd think, and it all comes back to that 1099. So picture this. You've done some amazing work, your client is thrilled, and they're trying to do everything by the book by sending you a 1099. The problem is, if their bookkeeping is, let's just say, a little messy, they can make a huge error that makes it look like you earned way more than you actually did.
And this is the heart of the issue. A busy client might just add up all the checks they sent you all year and slap that total number on your 1099. But that total amount, it often includes money that was never ever yours to keep.
So what are we talking about here? What are these so-called hidden costs that get bundled into your paychecks but aren't really your earnings? Well, they're usually things you paid for on behalf of a client, like reimbursed expenses or maybe even taxes you collected for them.
Yeah, the biggest culprits here are what we call pass-through costs. I mean, think about it. Sales tax, that's not your income. You're just a middleman for the government. And if a client reimburses you for the exact cost of shipping, postage, or maybe a product you had to buy for their project, that's not profit, right? It's just a pass-through. You absolutely should not be paying income tax on it.
Okay, so you might be thinking, all right, a little extra income tax, no big deal. But hang on. This is where a small mistake turns into a really painful one. It's not just about income tax. For all you self-employed folks out there, this is what we call a double whammy.
15.3%. Now, this is not your regular income tax rate. No, this is the self-employment tax for Social Security and Medicare. And here's the kicker. It gets slapped on every single dollar that your 1099 says you earned, whether it was actually your income or not.
And what makes this so brutal is that you don't get to choose. You pay your regular income tax, and then you pay another 15.3% in self-employment tax right on top of it. This applies to every single one of those misreported dollars from pass-through costs. And trust me, it adds up ridiculously fast.
Okay, let's make this real. Let's run the numbers and see just how bad this can be. Let's say your client accidentally overreports your income by just $1,000. Even if you're in a pretty low 10% income tax bracket, you'd pay $100 in income tax plus another $153 in self-employment tax. That's $253 gone. You just paid a 25.3% tax rate on money that was never even yours.
All right, enough with the scary tax stuff. The really great news here is that you can totally prevent this. You do not have to be a victim of someone else's messy bookkeeping. The solution is actually pretty simple, it's professional, and it's all about being proactive.
So let me introduce you to your new best friend, the reconciliation form. Look, this isn't some complicated legal document. It's just a simple sheet you create that clearly lays out the math for your client. You just list your invoices and you separate your actual service fees from any of those pass-through costs we talked about. It's really all about clear communication.
The whole process really just boils down to 4 easy steps. First, you got to keep good records. That's on you. Second, in your own books, make sure you know what's real income versus what's a reimbursement. Third, you send that reconciliation form over to your client. You can do this quarterly or just before the end of the year. And finally, number 4, when that 1099 shows up in the mail, you double-check it against your form to make sure they got the number right.
Now, hold on. Before you go and do this, there is one super important rule you have to follow to do this the right way, legally and ethically. We call it the no double dipping rule. The logic here is really simple, but it is absolutely critical. If you get your client to exclude, say, a reimbursed shipping cost from your 1099 income, great. But you cannot then turn around and deduct that same shipping cost as a business expense on your tax return. That's trying to get the same benefit twice. It's either not income or it's an expense. It just can't be both.
So the big takeaway here is really simple, and I absolutely love how our source material puts it. Don't be a dirty double dipper, right? It's a funny line, but it'll help you remember a really serious tax rule. Just be honest, be accurate, and you'll save money the right way.
So there you have it. Being proactive with the reconciliation form, it's a brilliant, simple way to protect your profits. And it kind of makes you wonder, doesn't it?
What other simple little checks and balances could you put in place to make sure you're protecting every single dollar you worked so hard to earn? Definitely something to think about. Thanks for joining me.